Okay, so we're going to look at two contra entries, which are return inwards, sales returns, and return outwards, purchases or purchases returns. Okay, so return inwards. This is when a customer brings back goods to you. Okay, probably they are the wrong goods. Probably they are damaged goods. Probably maybe it was a mistake. Okay, so they return the goods to you. Okay, so if you already made a sale, whether it be a cash sale to that person or a credit sale, right? When this person brings back the goods to you, it means you have to give them back their money, right, colleagues? Hello? You have to give them. Yes. So this return inwards or sales returns is a contra revenue account. Okay, contra revenue. Okay. If we remember our double entry rules, okay, revenue falls under income. Okay, revenue and income they increase with credit. So a contra revenue account means it's going to contra revenue account. It means you're going to have to debit it, right? Because it reduces your revenue. Yes. So for sales returns, whenever there's a transaction with sales returns, you debit sales returns. Why? Because it's reducing the revenue. So it's a contra revenue. So if we look at this example here, okay, we sold goods on credit worth 12,000 to Maria, right? Initially, we debited Maria. Okay, she's a debtor. She's owing us 12,000 kwacha. Okay, debtors assets. Okay, increase in an asset, you debit. Then we recorded we when we sold the goods according to the realization concept, even though you don't receive the money, you need to record it. So when we sold the goods to Marie, we recorded that our sales revenue has increased by 12,000 kwacha. Okay, even though we haven't received the money, but we're recording it according to the realization concept. Now, so Maria brings back goods worth 5,000. Okay. She brings back goods worth 5,000. So this is the return inwards here. All right. So as I said, return inwards is a contra revenue account. So it reduces revenue. So you debit, we'll say sales returns here. You debit sales returns. Yeah, 5,000 kwacha. Okay. Then how much Maria is owing us also reduces now. Okay, she was owing us 12,000. So she's brought back goods worth 5,000. So it means what she's owing us has reduced from 12,000. Okay, it's reduced 12 minus 5,000, it's reduced to 7,000. Okay, so that 5,000 reduction, we'll say it's a reduction in our asset, Maria, the one who's owing us money. Reduction in our assets. So you credit Marie 5,000 to say there is a reduction in how much she is owing us. Okay, and according to the double entry rules, remember, an asset increases with debit. So it means it has to reduce with credit. So we have to credit Maria. Reduction in an asset, and basically reduction in how much she's owing us. Any questions? Not assets, goods worth 5,000. Mhm. Yes, he is remaining some money. We have to record the goods which you brought, how much they are worth. Because if we record 7,000, those seven that seven those that 7,000 represents the goods she still has. But she brought back goods worth 5,000. Mm. Actually, yeah, we're good. Okay. When we look, once we reach the ledgers or the tier accounts, this is how it's going to look. Let me just give you an illustration. This is just a small, this is how you show the ledgers or the tier accounts. Okay. This is Maria's ledger or tier account. Okay. When she bought goods on credit from us, we debited her with 12,000, saying that she's owing us 12,000 kwacha. Now she's returned goods with 5,000. So you put this 5,000 on the credit side here. You return goods with 5,000. So 12 minus 5,000, it means what, how much is owing us is now 7,000. Okay. So we just record how much she brought back when we're doing sales returns. Any questions before move to the next one, the next contra transaction? Okay. Return outwards or purchases returns. This is when we take back goods to our suppliers. When the business takes goods back to the supplier. Okay. So whenever you purchase goods from a supplier, whether you paid cash or it was on credit, right? When you return goods, because they might be bad, they might be expired, they might be the wrong goods. So when you return the goods, that purchases expense has to reduce. Okay. That purchases expense has to reduce. So if you paid 10,000 for the goods and you bring back goods worth 3,000, that 10,000 kwacha expense has to reduce by 3,000. Okay. That's why we say purchase returns is a contra expense account. Okay. It reduces the purchases expense. Okay. So if we look here, initially, let's look at this transaction. Bought goods on credit from Peter, 7,000 kwacha. Initially, we debited purchases. Remember, whenever you incur an expense, you debit. Peter, we're owing him money. He's a creditor, so we're owing him. A creditor is a liability. Increase in a liability, you credit 7,000. So we're owing Peter 7,000. Now we are returning goods worth 3,000 kwacha. Okay. So it means that 7,000 we're owing Peter has to reduce. Okay. So purchases returns, since it's a contra expense account, remember expenses increase with debit. So a contra expense means you credit. All right. So credit purchases returns. Peter is a creditor, is a liability. Okay, we're owing him money. Now, since we've taken goods back, so it means what we're owing him also has reduced. So liabilities, remember, according to the double entry rules, they increase with credit. So when a liability is reducing, it means you have to debit. So you need to debit Peter to show that there's a reduction on what you are owing him. So you debit Peter 3,000, reduction in a liability, debit, and you credit purchases returns, okay, contra expense 3,000. Yes, that's the journal. That's the journal entry there.